안녕하세요. Good evening. Thank you so much for joining us this evening. What I want to do today is talk about our outlook for 2020 from an investment perspective. So the theme for this year is a balancing act. And there's two reasons why we chose a balancing act. Firstly, we obviously are trying to balance positives and negatives against each other. So our investment process for coming up with the views I'll share with you later is very focused on trying to find out why things good might happen and why things bad might happen, and try and balance those out to give a sort of net assessment, if you like, of what is likely to happen going forward. Secondly, this is already the longest US economic expansion since the Second World War. So while we believe this is going to continue in 2020, it will inevitably come to an end at some point. Whether that's 2021, 2022, it will come to an end. And we expect, as we get closer to the end, volatility of equities and other asset classes to increase over time. And that means that when you come to investing, putting all your eggs in one basket is a really bad way to go. So we really believe that diversification across different asset classes is really, really important. And so there's three sections to my presentation. Firstly, we'll look very quickly at performance of 2019. Then we'll take a look at some of the key views that we have on equities, bonds, dollar, gold, etc. And then the third section will dig into a little bit more detail into which areas within bonds we prefer, and do the same with equities. So, firstly, a review of 2019. So this is the performance over the past 6 years of our recommended allocations. Okay, so what you can see from 2019 is that actually it's a very strong return. So multi-asset income delivered 13%. A balanced allocation delivered 12%. Clearly a lot better performance than we saw in 2018, helped by strong equity market performance and also strong returns from bonds. What you can also see is that volatility, the triangles at the bottom, volatility was lower than in 2018, but actually higher than 2017. And we see this trend increasing. So volatility is likely to pick up over time. So volatility in 2020 is likely to be higher than last year, and again in 2021. So this is something to be mentally prepared for, as well as prepared for from a portfolio perspective. But a very strong year for investors last year. Obviously, the question we think about today is, what does the future hold? So this is a diagram of some of the factors that we believe are in a tug of war with each other when trying to determine what the outlook is likely to be. So on the positive side, we think growth is likely to accelerate globally. That's a pretty controversial statement a few months ago, but we're already starting to see global indicators improving. Whether you look at trade data out of China, auto sector, auto purchases in Europe and also in China, consumer sentiment in the US has also rebounded. So overall, the environment does seem to be improving. Certainly the risks of recession that we saw last year seem to be waning today. So overall, the growth environment, we believe, is a positive environment. Second factor is monetary policy. So we've seen, obviously, the US cut interest rates, the European Central Bank eased monetary policy, as well as China on January 1st this year. But it's not just the big three. We're seeing central banks almost across the world easing monetary policy, cutting interest rates to try and stimulate growth, but that's also creating increased liquidity into the financial system that's looking for a home. And that's likely to be driving riskier assets such as equities higher. Okay, so strong growth and lots of liquidity are a good environment for equities. One factor that might constrain performance is valuations. So particularly in the US market, valuations are certainly not cheap and are slightly expensive. The other side of that coin, though, is equities are still cheap relative to bonds. So you look at the dividend yields on offer or the earnings yields on offer relative to bond yields, they are still attractive. So yes, they're expensive just on their own basis, but relative to another key asset class, bonds, they look slightly cheap. So from that perspective, we shouldn't get too concerned about valuations where they are today. In terms of risks, obviously there's always positive risks and negative risks. We usually focus on the negative, but just to cover it off and be balanced, on the positive side is fiscal policy. So here we're focused on two countries. Firstly, the US. What is President Trump's number one objective this year? Re-election. He wants to be president for another 4 years. We may have our own personal opinion on that, but that's definitely what he wants. So he will know that historically, if the US economy is expanding, the president has been re-elected 90% of the time. That means if the economy slows a little bit this year, he'll be very quick to respond to that, obviously putting pressure on the central bank to ease monetary policy further, but also to push through with a fiscal stimulus. So that's a potential upside risk to our scenario. It's not a central scenario, but it's an upside risk. Another country is Germany. They clearly have the scope to stimulate fiscal policy. They have a mental block when it comes to doing so. But again, if the economy disappoints and doesn't live up to our expectations, Germany is likely to push that conversation along and start stimulating the economy. Again, an upside risk to the global environment. Okay, so that's the upside risk. Downside risk, geopolitics. We've been emphasizing for 3 years that geopolitical risks are going to increase over time. We expect to continue to talk about this for another 10 years. Okay, this is not an aberration. It is not going away. We may see some areas calm down this year, but we may see other areas flare up. And we'll talk a little bit in more detail about that in a few slides' time. But obviously, geopolitical risks, uncertainty generally are a headwind for equity market returns, so we have to bear that in mind. Okay, so we talk about liquidity being important for equity markets. This is just a quick chart to show that's the case. So global equities, the blue line, versus global money supply, the black line. And you can see the lines are reasonably related. A little bit of deviation when the trough was hit here by about 12 months, but generally there's a reasonable correlation between the two. We expect monetary policy easing that we've seen in the past 12 months and in the coming 6 months to drive money supply growth higher and pull equities with it. In terms of bond markets, a key benchmark is the US 10-year government bond yield. So on this, we can see that it has a reasonable relationship with inflation expectations. Okay, you can see inflation expectations, while they have risen slightly in recent times, they still remain very, very controlled after a very significant fall over the past 12 months. We expect inflation to remain relatively benign in the coming 12 months, maybe rise a little bit. That means that the 10-year bond yield in the US should remain relatively well anchored, around 2%, so maybe 50 basis points, 0.5% higher than we are today, but not dramatically higher. That is not just important, obviously, if you're investing in bonds. It is important if you're investing in bonds, but it's also important if you're investing in other income-generating assets and equities. So with a view that the bond yield will remain relatively low, even if it's a little bit higher than today, Another area that we like is something called multi-asset income. So diversified strategy aiming to generate around a 4 to 5% income. Now, I realize there's a lot of data on this chart, so I'll try and highlight the bits that I want you to focus on. So 4 economic cycles here. On the left-hand side is when growth is accelerating. Okay, so that's the scenario that we're looking at. So you can see in that scenario, we have different scenarios as well in terms of inflation. So is inflation falling or is inflation rising? Our sense is, if you twisted our arm, we'd probably say inflation may rise a little bit, which puts us in this second bucket. And when there, you can see that multi-asset income has historically generated around 9% returns. Okay, so given our sense of where we are in the economic cycle, we believe that maybe that's a little bit on the optimistic side, but maybe something in the 6 to 7% area could be achieved in multi-asset income this year. Okay, so that's where we're looking at. In terms of the dollar, on a general basis, so this is a broad-based dollar index, so about across key G10 currencies. We're expecting the dollar to weaken around 5 to 7% this year. Okay, and the key factor for this view is, again, that liquidity that we're seeing, that dollar liquidity. And again, you can see dollar liquidity going up here is actually contracting, coming down is actually it's peaking out and getting better. So we see dollar liquidity starting to accelerate, and we think that will drag the dollar lower with it. Okay, the dollar has not yet broken lower, but we think it will break lower by about 5 to 7% this year. That's obviously very important when we talk about different asset classes going forward. We mentioned geopolitical risks. Here is a list of different areas that you could be looking at. I think from our perspective, US-China, that was largely a 2019 story. Okay, so the trade deal probably puts this conflict on the back burner for now. Longer term, we still think it's going to be a major concern, but maybe this year we have a little bit of a breather. We've seen Middle East tensions pick up at the beginning of this year, but they ebbed very quickly. It took about 6 hours from what looked like a very challenging environment to be pushed back and delayed. But I think the area we're going to focus increasingly as we go through this year is the US presidential election. Obviously, Trump needs to survive impeachment proceedings first, but also Democrats need to pick their candidate. If that's Biden, then the election will probably be less entertaining. If the candidate is Sanders or Warren, it's probably going to be much more entertaining because their policies are quite different, non-consensus, and could be quite challenging from an equity market perspective. So we need to watch out to see, as we go through March, Super Tuesday, and by the end of March, we should have a pretty good idea who the Democratic candidate's going to be. That's going to be really important, we think, for the performance of equities in the second half of the year. So the environment of a weaker dollar, still high geopolitical uncertainties, and as this chart shows, relatively low real yields means that we like gold. Okay, so we continue to think gold's a good diversifier in a portfolio and could do well on its own from its own perspective. The only caveat we have here is we had a target of 1,600 for gold this year. We hit that target on January 8th. Okay, so we had 365 days to hit that target. We did it on day 8. So we would be looking for opportunities, looking for dips in gold to buy rather than necessarily chasing this higher today. So just look for dips to maybe 1530, something like that. That would be a good opportunity to build gold position in our view. Okay, so that's the sort of key top-level views. So bullish equities, not bonds doing okay, but yields a little bit higher. Gold doing well. Multi-asset income strategies doing well as well. So that's sort of the headline views. Now what I want to do is dive a little bit deeper into the preferred areas within both bonds and equities. So as I mentioned before, the returns on bonds last year was very good. The negative aspect of that is that, as you can see here, yields have fallen markedly. Okay, so prices go up, yields come down. So one of our favorite areas in bonds last year was emerging market US dollar government bonds, and you can see the yield went from around 7% to around 5%. So obviously the yield is significantly lower looking forward, right? So those 13% returns last year come at a cost when you're looking at forward-looking returns. So we still look for positive returns this year, but nothing like what we saw last year across the bond space. In terms of areas we like, so I mentioned the fall in yields we've seen in this asset class. It is still a preferred asset class of ours. Okay, so despite that strong year last year, 3 reasons for this. Firstly, the yield is still attractive relatively, so 5% yield when the 10-year US government bond yield is around 1.5, 1.6, is still attractive. Okay? Secondly, as you can see from this chart, valuations are fair. They're not expensive. So this is the credit spread over US Treasuries. So the higher on this chart, the cheaper the asset class is. And you can see we're around that long-term average line. So neither cheap nor expensive. And the final reason is we see credit quality in this space improving this year. Last year clearly saw Venezuela, Argentina, and Chile having challenges, but despite that, we're seeing credit quality starting to improve, and that should be supportive of inflows into emerging market US dollar bonds. The second area within bonds remains in the emerging market world. In fact, all 3 areas that we prefer do. But this is emerging market local currency bonds. So instead of bonds issued in US dollars, they're issued in their own currency. Now, if you think about the returns that you get from an asset class like this, there are 3 potential sources of return. Okay? The first is the yield, around 5.5%. So again, an attractive yield on offer. Secondly, you can get price returns, positive or negative. So if the yield goes up, prices fall, and vice versa. Our sense is here that we may see very small price appreciation, but probably not significant. So it's not going to be a major driver of returns this year. But the thing that's led us to become overweight this asset class is our increasing conviction that the dollar will weaken, which will help emerging market currencies go up. So that currency return, you can see negative currency return in the past 2 years. We believe that's going to start turning positive this year, providing potentially a significant upside for the asset class as a whole. So 5.5% yield plus FX return, you could be getting into the high single digits for this asset class. Okay, the final area within bonds is Asian US dollar bonds. Now, this is an interesting asset class because it gives you a significantly lower yield, around 3.8%. Okay, so it's nothing like as attractive as the other 2 from a pure yield perspective. But it is 75% investment grade companies. Okay, so from a credit quality perspective, it's got high credit quality. And also, its volatility is low. So if you just ignore the light blue line and just focus on the black line and the gray line for now. So the black line is developed market investment grade companies. And the bottom line is Asian US dollar Asia US dollar bonds. Now, if you were to say, ignoring this chart, if you were to say, okay, I have a developed market asset class versus an emerging market asset class, which would have a higher volatility? Most people would say the emerging market asset class would have higher volatility. If you then said one is pure investment grade and one is investment grade with a little bit of high yield, you'd say that the investment grade with plus a little bit of high yield would also have greater volatility. But that's not the case here. Okay? So you can see that investment grade bonds, developed market investment grade corporate bonds, volatility is higher than Asian US dollar bonds. And the reason for this is a lot of companies issuing these bonds are from China, which you may say adds some risk. But what actually has happened historically is when Chinese investors send their money overseas, they buy these bonds. So actually when people onshore get more worried about China, more money flows outside, and sometimes the volatility of the asset class actually goes down. Okay, so add in the fact that the yield is more than 1% higher than developed market investment grade bonds, and with lower volatility, we think this is a very attractive asset class, particularly for more conservative investors. In terms of equities, just recap some of the reasons why we like equities. So we've talked about the first two factors, liquidity, and we move on, then we talk about some of the other factors we haven't mentioned. Sorry, relative valuations was the second one. Sorry, my Korean's not very good, so I'm struggling to remember what each of these are. The third one is a quantitative model. So based on our quantitative modeling of the economy, where we are in the cycle, it suggests healthy equity returns globally. If you look long-term, forecasted returns, so expected returns over the next 7 years, equities have a higher expected return than bonds. Not surprising given how low bond yields are, of course. But bond equities are still expected to generate higher returns on a 7-year forward-looking basis. Share buybacks, we'll talk about that in the US example, but we are seeing UK share buybacks and Japan share buybacks as well. And finally, we've seen some tax cuts in recent years, starting with the US. Last year was China and also India. So we're seeing tax cuts coming through as well, which is obviously good for corporate earnings. So within equities, two of the areas that we like are the Euro area and US. So we'll talk about Euro area first. It is very clear from history that if you are bearish on the European banks, then you shouldn't expect European equities to do well. Right? So the relative performance of Euro area banks within Europe correlates very well with the relative performance of European equities relative to global equities. So if Euro area equities are outperforming, Euro area banks are outperforming, Euro area equities are outperforming, and vice versa. Now, what this chart shows you is the one measure of valuation, price to book, so the Euro area market as a whole, and Euro area banks below it. And you can see that gap's been widening out significantly. This is obviously quite a long-term chart, 18 years, but you can see it's been widening out and has continued to widen out even last year. We think this is probably going to reverse over time. Okay, so we're expecting Euro area banks to start outperforming. And the reason for this is, one is the growth cycle that we're seeing in Europe. We expect that to put upward pressure on German bond yields more generally. Emerging markets are a significant exposure for the European banks, particularly in Spain. And we see the domestic credit stimulus coming through. So demand for credit is picking up, supply of credit is also picking up. So this all should be positive for the euro area banks and help drive some outperformance of the euro area market. In terms of the US, we mentioned share buybacks. We're expecting share buybacks to amount to around $700 billion this year. You can see from 2010 to 2019, it's already gone up very sharply. We expect it to remain very high this year. And two reasons for this, and it's shown in the black bars here. We expect the cost of debt to remain low. We talked about bond yields being low. We expect the cost of debt to remain low. And the earnings yield over that cost of debt is expected to remain wide. We've seen it's widened significantly here. So the financial incentive for CEOs and CFOs to continue to buy back their shares is still very high. Okay? So a lot of people will talk about fund managers being net sellers of US equities. So last year was about $50 billion worth of net selling of US equities. Makes you wonder, how could equities go up if people are net sellers? Well, obviously, $700 billion of share buybacks far outweighs that $50 billion in outflows. So that's what's supporting the market. The only thing that's likely to stop this type of behavior, in reality, is a recession. Right? So we expect share buybacks to go in right through the end of the late cycle. Coming closer to home, Asia. It's not a preferred area, but it's a core holding. But we're still bullish on Asian equities. One of the reasons is obviously reduced trade tensions. One area is semiconductor sector is also doing well. So from that perspective, we do see signs that the tech sector will help drive some strong performance in Asia. So that's coming through. So that leads us to where are we overweight within Asia? So we're overweight Korea, not surprising if we're talking about a bullish semiconductor outlook. We're overweight India, and we're also overweight China offshore equities, if I can. There we go. So last year, we were overweight China onshore equities. It's very focused on the domestic stimulus. We saw trade tensions as a headwind more for the offshore market than the onshore market. We've switched this year. One reason is we do see a stimulus, so we still like China overall, but we prefer the offshore market because we see trade tensions ebbing, so that trade deal, and the offshore market is much more open to trade, much less domestically focused. So from that perspective, this should get a bigger kicker. Now, naturally, the coronavirus is something that everybody's worried about, and I think we do believe that the coronavirus news flow will get worse in the coming 2 to 4 weeks. But what gives me comfort that this will not be something to worry about in 2 months' time is, one, the Chinese authorities have been much faster to respond than it was in SARS. And secondly, while it's still very contagious, the mortality rates are thankfully much lower. So from our perspective, yes, we will see more and more infections over the coming 2 to 4 weeks that could look at some points almost exponential, so we have to be prepared for that. But we don't think this is going to be something that is going to threaten markets in general, or the Chinese market in particular. It could, of course, lead to some short-term market weakness, as we've seen earlier this week. So we had been arguing that global equities could see a pullback of 5 to 7% due to their overbought nature. This could be the stimulus for that pullback, but we'd be buying into that dip. So that's really all I have to go through. So just a quick summary. So first of all, at level 1, we're overweight equities and we're overweight gold. Okay, so within equities, we have a preference for euro area equities and US equities. Within bonds, we like all the emerging market assets, so we prefer emerging market bonds over developed market bonds, so So we like emerging market local currency bonds, emerging market US dollar bonds, and Asian US dollar bonds. We expect the US dollar to weaken around 5 to 7%, so putting some numbers on that for currency pairs. So that means euro, we think will close the year around 117, and we think sterling will close the year around 141. And with that, I'd like to thank you for your attention and your time this evening. 감사합니다.